over the 11 years, we've explored a range of topics. And interestingly enough, even though Citi Foundation is the philanthropic arm of Citi Group, we've actually never had a topic that focused on financial services, which is sort of staring at you in the face and didn't seem so obvious, but I think it's incredibly timely. As you all know, a main component of this program is to identify a distinguished leader in their field to spend a year with students and faculty and expose them to fresh ideas, new perspectives, some outside voices on a range of topics in business leadership and ethics. And so the choice to focus on financial services this year, I think actually that maybe it was an accidental good thing that we didn't focus on it before, because I actually think that this is discussion that's very interesting and unlike any other that we've had over the 11 years. Clearly, look, I don't have to tell all of you, that consumer finance is really part of the national dialogue and key to issues of our national economy. And while the height of the financial crisis is behind us, the reality, if we're being honest with ourselves, is that the legacy of the financial crisis is still with us. There is still mistrust of private sector leaders, particularly in the financial services industry, and the after effects on national, local, and household level economies are still with us. The other reason why I think this is a great time to have this conversation is that moving forward out of that crisis and really focusing on repairing and rebuilding is not so easy. It's more complex than we realize. And it's not simply about restoring the system that was, but it's really about forging a new financial services ecosystem. And to do this, I think regulation is incredibly important, but regulation alone isn't going to do the job. And a key piece of this is we really need to have a whole new generation of financial services industry leaders who take this on and understand both the complexity of the situation, but are really committed to forging this new way of doing business and this new ecosystem. And I have no doubt that some of you are actually that next generation of leaders. The speakers you're going to hear from today have been at the cutting edge of these issues even before lawmakers, regulators, community activists, bankers, media, the general public actually realized what was happening. The people that you're going to have exposure to today didn't start thinking about these issues in 2008. They've been thinking about these issues in 1998, 1990. They've really been at the forefront of this for a long time. And no one has been more at the forefront of this dialogue than our fellow today, Ellen Seidman. So it does give me great pleasure to introduce your 2014 Citi Fellow, Ellen Seidman. If you have in your packets a long list of bios, all the details about everybody, and actually if I tried to even summarize Ellen's bio, it would take me an hour. So I'm not going to do that, but I'll give you a couple of highlights. Currently, Ellen is a senior fellow at the Urban Institute focusing on housing finance and community development. In addition, she simultaneously holds a role as a research fellow at the Filene Research Institute, which has a particular focus on the credit union industry. And for the past 2 years has been a visiting scholar with the Community Development Department of the Federal Reserve Bank of San Francisco. I would encourage all of you, I know you guys don't have a lot of spare time, but I think it's worth it. Google investing in what works in America's communities. There is a whole collection of essays that the Citi Foundation, working in partnership with the Fed and editors, including Ellen, have put together, thought leaders from around the country thinking about and reflecting on what has happened in America and what do we need to do in order to ensure economic opportunity for all. Over the years, Ellen has served in a variety of government roles. The one that is most memorable to us at Citi was when she was actually our own regulator, when she headed up the Office of Thrift Supervision. Some of you may be wondering, what regulating agency is that? It actually doesn't exist anymore, but boy, it was powerful and mighty under Ellen. And, the other piece is that Ellen really plays an important role in the community development finance industry. She has is on the board of several CDFI lending institutions. She's really been a thought leader and a catalyst and an entrepreneur herself in the community development finance arena. And she's a founder and board member of the Center for Financial Services Innovation. Okay, that's all the official stuff I'm going to say about her. And I'm also not going to make this sound like Ellen's eulogy and, say all the things that she's been great at. And the reason why I'm not going to do that is actually because Ellen is quite fearless about speaking her mind, and she would be the first one to pull me off the stage and tell me to be quiet. But I do have to make one comment. The real reason why Ellen was the top choice this year is not necessarily because of her credentials. And it isn't actually because of her expertise and her ability to provide answers to hard questions. It's actually the opposite. It's because we've never met anybody that knows how to ask a harder question and a more complex question and then do something that's very rare in the world. Actually figure out how to engage people in a discussion and a dialogue so we move from the complexity to the answer and from the answer to action and from action to results. So with that, I'd like to introduce our 2014 fellow and our friend, Ellen Seidman. Thank you.
So thank you very much, Brandy. That was really nice, and it doesn't sound like a eulogy at all, so that was good. I want to thank all of you for being here today, and to thank not only Brandy and the Citi Foundation, but also Bruce Buchanan and the NYU Stern Leadership and Ethics Program for providing the opportunity for all of us to come here and think about and talk about frontiers in consumer finance. Now, consumer finance is actually a really important topic. It's how we turn earnings into useful currency to buy things and pay bills. It's how we save and invest. It's how we borrow and repay. And it has changed dramatically over the past 40 years, over the past 5, and it is continuing to evolve. And so if you'll let me take a little trip back, let's go back 40 years. That was the era of banks, savings associations, finance companies, something you've never heard of, and cash. People had savings accounts, usually with passbooks that got stamped every time you deposited money, which required an actual physical trip into the bank, and which for little kids in particular was a really big deal. Checking accounts, which were not all that common, had monthly fees and sometimes also fees for every check you used. But they didn't have overdraft protection. But, the really high credit people could get a backup line of credit. Credit cards, or as my mother used to call them, charge plates. And she called them a charge plate because actually it was this little bitty metal thing, were rare. There was some store credit, including layaway, and many, and more of those had attached cards. But if you needed to borrow money, especially for other than a car or house, where you went was a finance company whose business was small-term loans at pretty high, although not outrageous, interest rates. Other than buying a house, always with a 30-year fixed-rate mortgage, investment pretty much meant a company pension plan if you were fortunate, and perhaps payroll savings, in which money was deducted from your paycheck to buy U.S. savings bonds. Mutual funds didn't exist, and fees for buying individual stocks were high. And lots of people got paid in cash. There was no direct deposit for those who didn't. Now, if we check back 5 years ago, things had changed dramatically. About 90% of the population had checking accounts, and free checking, which came with significant overdraft fees. That's part of the reason that many lower-income families did not use them exclusively, relying on non-depositories, that is, things that are other than banks and credit unions, for check cashing, bill payment, and remittances in particular. Direct deposit was increasing, but most people, especially outside of large corporation, were just paid with checks. Much of the population also had a savings account, but with interest rates really low and fees on many accounts, people who had some liquidity looked elsewhere, especially to money market mutual funds and to mutual funds. Credit cards were ubiquitous, but many came with high and hard-to-predict fees and with penalty interest rates that ran up the balances very fast for people who didn't pay the monthly minimum. And mortgages were beginning to become harder and harder to come by as house prices declined, foreclosures exploded, and unemployment started to increase. Very few depositories offered small short-term debt outside of credit cards, and the finance companies were all gone. Payday lenders and related alternatives, such as pawn shops and auto title lenders, were proliferating. Defined benefit pension plans had been replaced by defined contribution plans, even in government and urban and union workplaces. And many workers had not saved enough for retirement, even before unemployment and the Great Recession decimated their accounts. Now, moving forward to today, there's some things that have gotten better. There's some things that haven't improved very much. The portion of the population with checking and savings accounts has declined slightly, but more importantly, alternatives such as prepaid cards are growing steadily. Latest numbers are that 13% of the population now uses them. And totally mobile accounts, where there may be a bank in the background, but there's no brick and mortar, are beginning to catch on. Free checking is under significant stress because of limitations on debit card interchange fees and regulatory pressure on overdrafts. You may have noticed an article in the Wall Street Journal yesterday about Bank of America beginning to issue, in essence, a very old-fashioned checking account, one monthly fee, no overdrafts, but it doesn't have any checks. It really reminds one of checking accounts back in about 1970. Good short-term credit is even harder to find, as the Card Act made credit cards better products, but lenders responded in part by reining in credit, and few good alternatives have appeared, notwithstanding the efforts of many. And the investment vehicles most Americans depend on, namely houses and pension funds, while coming back, are still under significant stress, in part because of equity taken out of both during the bust. And the wealth gap is even larger than the income gap. So where does this leave us? And believe me, I did not talk to Brandy before I wrote this, with a lot of questions. Okay, so the traditional account is probably on its checking account is probably on its way out. But are traditional brick and mortar banks and credit unions going with them? What will take its place? What's the role of mobile banking, especially the newer versions like Movin and Simple, that are not just doing your regular banking on a smartphone? And what will be the role of the telephone companies and Facebook and Google, not to mention Bitcoin? How will prepaid debit and credit cards evolve? Who will have access to each, and who will use them for what? Will we solve the small dollar credit problem, enabling those who need it and can pay it back, have easy access to products with reasonable prices and fees, and with terms designed to encourage repayment? And what will happen on the mortgage front? Washington is on the verge of a major restructuring of the mortgage market, but it's happening in fits and starts. And meanwhile, credit continues to be extremely tight, even as the economy is improving, and more people who want to become homeowners probably can afford it. At the same time, there are major demographic changes going on. The next generation of home buyers will probably be older, have less income and have less certain incomes and more debt, and have less chance of getting significant help from families than their parents did. Moreover, at least some people are asking whether rental will become the tenure of choice longer into the life cycle for many more households. And at the other end of the age spectrum, will aging boomers be able to sell their houses to the families in the middle? The answer to that question may be very different in different parts of the country and for different types of housing. And finally, we are really unsure about the state of retirement for not only those currently nearing the natural end of their full-time employment, but also for the older long-term unemployed who may never find jobs that supplement meager savings and Social Security in retirement. Those who are still employed, but who do not have pensions or who never built up their accounts or whose accounts were decimated in the recession. And then all the young folks who are making a living freelancing and moving from job to job and place to place and maybe having a ball and are feeling really, really fulfilled, but who will need a different structure than we've been used to in order to see them through their full lifespan. Now, in the face of all this change, I think we need to be establishing some beacons to guide all of us, industry, consumers, advocates, the media, the government, toward a consumer financial system that, while providing a wide range of choices to meet disparate needs, gives consumers the best opportunity to be financially healthy in both the short and long term, and does it in a manner that, for the most part, is financially rewarding enough to enable the private sector to do the job. A few years ago, the Center for Financial Services Innovation, or CFSI, which I helped start and whose board I chaired until recently, decided it needed to tackle this problem. For several years before, we had been working on understanding the financial services needs of the full spectrum of consumers, making those needs broadly known, and working with individual providers, both for-profit and nonprofit, to put good products into the market. But it was clear to us, both staff and board, that in particular, building awareness without setting out some quality standards ran a significant risk of replicating the predatory mortgage lending disaster. But we also knew that if we simply put something out there, no matter how good it was and how much success we'd had on the awareness front, if we were lucky, it would be the equivalent of the food pyramid. Nice to know it's there, but who on earth uses it? So CFSI spent about a year talking to many stakeholders, working with a smaller but diverse group of people who cared about prepaid cards, which is something CFSI knew a lot about, and iterating draft after draft. The result was the Compass Principles, 4 relatively easy to remember, although I must tell you I have trouble remembering them, broad but meaningful beacons to help providers, consumers, and regulators create, assess, and use quality financial services products. And by the way, these principles, while they were born primarily out of a concern about financial services for underserved consumers, are much more broadly applicable. So here they are. Embrace inclusion, which means responsibly expand access. Build trust by creating and marketing products and services that are mutually beneficial. Promote success by making it easy for consumers to succeed through design, innovation, and careful ongoing research into how products are being used and how to make mutually beneficial improvements. And create opportunity by providing options and opportunity for upward mobility. 8 simple words: embrace inclusion, build trust, promote success, and create opportunity. But they are built on 6 core values, which are also critical to their practical implementation. Financial services must be sustainable, which almost always means they need to be profitable, although the level of profit and the scope and time period of measurement are definitely variable. Second, the best products and services arise from deep customer knowledge, although it's important to acknowledge that so do some of the worst. Safety is fundamental, which particularly in an economy of unequal information and resources requires sound regulation, broadly and effectively enforced. Fourth, because we all have different needs and different wants and those change over time, there is value in variation and choice. Fifth, relationships rather than simply transactions are key to long-run mutual success. And sixth, working collaboratively across not only industry sectors, but also with consumers, community-based organizations, and advocates, and with regulators, will lead to the best long-run outcomes, even if the process is messy. Beth Brockland of CFSI, who is on the second panel today, will talk more about how the Compass Principles are being used to not only generate best practices, but also to design, test, and evaluate products and services. Can we use the Compass framework to provide some guidance in thinking about the future, to answer some of the questions I raised earlier? I think so, but before I start, I want to be clear about three things. First, we've got an incomes problem in this country. Incomes have been stagnating for decades. Today's median is lower than the median in 1986 in real terms. And the solution to that problem will not be finance. In fact, I would argue that excessive reliance on finance, and in particular on credit, has both masked and exacerbated the income situation. Second, we are not in a post-racial society, whatever that means. Discrimination on the basis of race and other factors continues in many facets of our society, including financial services. And third, disclosure and education can be useful tools, but too often they're an excuse for obfuscation and an opportunity to blame the victim. We do not get on an airplane and place our reliance on a description of how it works. We trust that the plane is safe, the pilots know how to fly it, and that the governments have safety regulation and an air traffic control system that enables both. So within the Compass framework, here are some of my thoughts about where we're headed. First, information about who we are and what we are doing financially will be ubiquitous. And providers who know how to both anticipate our needs and meet them in a manner that earns our continuing trust will be the most successful. Now, this appears to give an edge to the Googles of the world, but I think it also favors those who know us on a much more local and personal basis, who interact with us regularly and understand not just what we want or need today, but also our long-term aspirations and fears. The most valuable information for consumers will be the information about us that we have access to, not that's hidden in the systems of providers. The challenge will be to get us to use that information well, to our own benefit. Many new players will come and go, and many of us will be continually trying out new things. But ultimately, the players who are able to convince us that they will be around in the long run will be the most successful. Now, tying all these together suggests that for many consumers and in many communities, the winners may well be entities that are not primarily financial services providers, but primarily meet other needs, whether it's employers, a throwback to an earlier period, schools, healthcare facilities, retailers, or places of worship. Second, we need to find new ways to think about credit, both short-term and long-term. As I mentioned already, somehow we have to keep ourselves from falling back into the idea that credit can substitute for income. At least this time, one would hope that both politicians and the financial services industry, who got burned pretty badly the last time, although not as badly as consumers, would not fall into the same trap. Now, the traditional answer to this problem has been that banks and credit unions, which are chartered to serve their communities, should serve everyone, and in particular should provide quality credit to everyone. I'm not quite ready to give up on this, but I do not think it is ultimately going to solve our problem. We'll make some improvements at the margin as we move away from the financial crisis, most likely by some combination of automatic savings and the use of transaction information to do better underwriting, plus some loosening of current credit standards, including through the use of secured credit cards. And there's likely to be some increased coverage by credit unions who serve a broader population. But many will still be left out. And on the credit side, some who cannot reasonably repay debt on reasonable terms, appropriately so. There are other issues with that group of people, and we need to deal with those. Satisfying answers may be closer with respect to mortgage debt, but only if the industry and the political system can get creative in a constructive way. And as someone from Washington, I'm not sure. The Dodd-Frank Act and the work of the Consumer Financial Protection Bureau have hopefully curbed the worst mistakes of the bubble era. There's not the insignificant issue of what's going to happen to Fannie Mae and Freddie Mac, but some consensus appears to be developing on that front also. In many parts of the country and for many people, all that is needed is some slight loosening of currently tight credit standards to bring homeownership back into play. But we need to do more. We need to explore limited ownership options that provide the advantages of ownership, in particular, stability and the opportunity for leveraged wealth building with reduced cost and risk. Community land trusts, and particularly in places like New York, limited equity co-ops, have had some success, but both lack significant scale. Two particular issues involving credit that we will need to do a better job on are loan servicing and debt collection. In contrast to choosing a lender, consumers have no say in these choices, which have substantial impacts on their financial health. Regulators in Washington are trying to tackle both issues, but they're difficult, in part because they tend to be underpriced on the front end to keep credit costs down and maximize profits on origination. But the result is lousy systems and shortcuts that don't serve either borrowers or lenders well. If the regulators get it right, front-end costs for credit will go up for most of us, but debts will be collected more efficiently and with greater sensitivity to the concept that sometimes helping a borrower in trouble by modifying a debt is a win for everyone. Now, while credit is hard, I think we actually will get to the answers there. But investment and asset building are really something to be concerned about, especially outside of homeownership and pension plans, whose reach and effectiveness is limited. It is extremely difficult for the average American household to invest and build wealth, whether for education, retirement, to tide over difficult periods, or simply to provide lifestyle choice. And it's particularly difficult in the younger generation. Some new work has just come out in which they found that of the age group of 21 to 29-year-olds, 46% have student debt averaging $30,000. 42% are earning less than $25,000 a year, and 1 in 5 are still living with their parents. It's a tough row to hoe from there, and many of you know that. Now, we're seeing some stirring from an interesting potential partner, namely the federal government, with the proposed MIRA, but there's a lot more to do. In part because of concern about people living paycheck to paycheck, there's been a good deal of focus over the past 10 years or so on creating mechanisms to build emergency savings. I completely agree that that is the essential first step. But it's not asset building. It's not an asset building investment. If you think back, and I know this is going to be hard because you were probably about 2 years old, but let's just try it, to the concept of individual development accounts, or IDAs, which were matched savings accounts that engendered a good deal of experimentation in the 1990s and early 2000s, and that still exist today, although in quite limited numbers. The focus wasn't on emergency savings. It was on savings for capital investment, for a home, a business, or education. In a very low interest rate environment like the one we've had since the early 2000s, building up anything beyond an emergency fund through saving is extremely hard. Homeownership works as an investment vehicle under most circumstances because of financial leverage and the steady increase in nominal, if not real, house prices over most periods. But it doesn't work in all places, it doesn't work at all times, and it's less accessible today than it has been for years. And rents are skyrocketing, making saving for a down payment even harder. At the same time, the soaring cost of education has made it more difficult to leverage savings effectively for that purpose. And even though in New York it feels like small business formation and entrepreneurship are alive and well, according to the Kaufman Foundation, the rate of small business formation has in fact been declining and is lower than it was in the 1980s. So in many ways, the question that may be hardest of all is how ordinary Americans will, over the next 20, 30, or 40 years, create and maintain a financial stability, not only for today and tomorrow, but for their entire lives. It is a huge challenge, and one that I hope you're inspired by today's events to help this country meet.